Thanks everyone. And before we start, let me also thank the Digital Fifth team. Globally, there are a lot of events like Cybos, which happen every year in most of the quadrants. But I think Samir and the Digital Fifth team, they've given a lot of importance to one of the most fundamental, part of the banking, which is transaction banking. And we've had a series of discussion in last few years, and I'm sure some of you have been following this. And of course, today we have Aman, Mahima, and Vivek. So, I think the MC, she spoke about a lot of heavy words, right? And I'm sure in first few sessions we tried to simplify, because the corporate banking essentially is quite different and far more complex compared to retail payments. Retail payments, we've seen the great wave of UPI and UPI-led innovations. But today we'll talk more about again, foundational or fundamental thing which corporates and banks are focusing very heavily. If you talk to 9 out of 10 customers, corporates, mid-sized customers, MNCs, they'll talk more about these aspects. And then we'll try and educate the entire audience present over here. So thanks once again for the opportunity. And welcome all of you. So being a career transaction banker, we had seen the word cash management evolving, and now some of the banks are saying treasury and trade solutions, global liquidity solutions, transaction banking. Essentially, the core foundational thing is liquidity, because, and earlier in earlier days, it was predominantly end-of-day statements. We all had seen that word. But now I think after so many black swan events, the digital or real-time payments and the expectation which a retail consumer has, that if retail payments are real-time, why can't corporate payments be real-time? And essentially the liquidity has to be real-time. And I think that's the way banks have taken the lead and built these APIs, right? I remember talking to Vivek a few years ago when I was a banker, and they had built the fantastic API banking suite in Yes Bank. And that's why I think probably most of the Indian banks, and now of course IDFC is building incredible stack. Citi has been doing great amount of innovation in API banking and liquidity. So maybe with that brief and a couple of pointers from my side, when I started Transbank with my co-founders, RBI came up with current account circulars, and these are some regulatory or various type of things because of which we thought that creating a multi-bank liquidity management or treasury management system is more important, and that's where we started building these things. But what we've observed in last few years is the things are evolving, right? And as recent as December 11th, we saw another circular coming from the regulator making so many changes, right? Which essentially underlines the importance of the entire cash flow management liquidity. So I think with that, we'll start the panel discussion, right? Just want to quickly unlock these heavy terms. While we have talked a lot about transaction banking, cash management, specifically case in point is the real-time liquidity and cash management. So maybe we start with Mahima. And Mahima, what is it that we look at when we talk about the large corporates, when they are redefining their liquidity management, be it domestic, be it cross-border? How important it is for the corporates or MNCs or any of the mid-corporate guys?
Sure. No, thanks, Vaibhav, for that, and thank you so much for setting the context as well. If I look at it, and if we have to define one real shift that has happened for corporate treasuries, I would say it is this, that liquidity has really moved away from being managed in cycles to being managed in motion, right? Gone are the days where treasurers were within the constraints of cut-off cycles, batch processing, settlement delays, right? Visibility to liquidity for them was in retrospective. The buffers that they built into their businesses were intentional. And float was something that just happened as a part of that system. But what has happened with real time, as you rightly pointed out, Vaibhav, is that it has completely shaken that to the core, right? Liquidity has changed color. The visibility to the liquidity has to be immediate. The deployment of the liquidity has to be instant, and optimization of liquidity has to be continuous process. What it has also done is that it has changed the way we look at end-of-day balances to actually intraday decision-making. And it is not really theoretical, right? We have seen this happening globally across multiple geographies. You know, you pick up PIX in Brazil or RTP in the US, you know, all of those point out to the fact that as real-time payments progress, volumes scale, there is a definite shift from end-of-day management of liquidity to real-time management of liquidity, right? So the treasurers are therefore really looking at how they should manage liquidity, right? Closer home, right? And as you said, cash management itself has evolved quite significantly, right? We were in a model where, you know, we were largely in a network-led model. Cash and check used to be very, very heavy part of any treasury. But that has obviously shifted quite significantly, especially in India with all the developments that have happened here. For us, for example, at Citi, right, we have seen that majority part of our cash flows, cash management flows are digital in nature, and progressively we've seen physical go down. But you know, we have to remember the reality in India is not that binary. So while we have seen on one side the digital payment landscape has grown 45% CAGR over last 5 years, we have also seen that the cash in circulation in the economy has significantly increased even after demonetization, right? So the point is that for a treasurer, it is not a choice between analog or digital today. It is about how they make the best and most optimal use of liquidity that they have and extract whatever value that they can out of the, you know, digital means that they have. So one of the things that we have seen is that treasurers are looking at really deep integrating their ERPs with banking platforms so that the liquidity is not just bank statements, but they become a very integral part of the corporate workflows. You know, there is API-led fund movements, there is prediction on the cash flows, and thereby right deployment of the funds that are being generated. So obviously, treasuries are getting complex day by day, and you know, they are always on treasuries. And banks like us are evolving ourselves as well in terms of, you know, what liquidity frameworks we can create around it to support our clients, because, you know, liquidity is no longer just a balance sheet matrix. You know, it has moved to being a very, very strong lever of growth.
Thanks, Mahima, for the great view from a treasurer and bank perspective. Vivek, I think ever since I known you for so many years, you've been our guy who's built products for the industry. We have Asit over here. He's been a mentor to all of us. How difficult it is, or how easy it is to build these products, especially when the industry sees so heavy words, and Mahima talks about the requirement of customer, which is ever evolving, and then you have so many regulatory landscape. How difficult or how easy it is from a product standpoint? Is probably would like to learn from you.
See, the fundamental dichotomy which we all as cash management practitioners have to deal with is, it's like a proper game of chess, right? Three-dimensional at that. For instance, what my objective as a cash management banker for my bank is to, in Indian context, is to try and get as much low-cost deposits as possible to have it deployed and make it as profitable as possible, which means I rely on float, which Mahima was relying on. And the objective of the corporate treasurer with whom we are interacting is exactly the opposite. Now, how do I not leave even a single rupee on the table? So now, in this mix, I'm also competing with the likes of Mahima and Aman and other people as well, right? So we are all following over each other for the same pie. In this context, unless you wear the enterprise hat or have a wider view at things, and if you just look at it only from a narrow product perspective, it may not anymore fit the bill there. So the real thing is about trying to extract the relationship value from the customer, right? And in the good old days when we were starting cash practitioners, what HDFC used to do is still the template which everybody needs to pursue, right? You try and create an ecosystem where you are able to bank the whole chain. Only then, in a limited one country kind of environment, will you be able to maximize value for your customer. And unless you have products designed to maximize value for the customer, you're really just catching up and reacting to some news which has come here, some bank which has introduced something, and therefore so on and so forth. So one of the things which we have realized over a period of time is that you cannot resist or depend on inefficiencies at the client's end. So your products would have to be defined with the client in the center. But obviously we have to earn our own bread and butter as well, which means that how do I create those difficult conversations with the rest of the bank to try and create synergies to ensure that wherever the customer is moving the money, I bank them as well. And therefore, I'm able to give real-time value, I'm able to give them real-time insights, and so on and so forth. Easier said than done, but in the global context, it becomes a bit more difficult because the same term cash management gets referred to in sexier terms, right? You call it cash pooling, notional pooling, cash forecasting, etc., as well. All of this is not required if real-time payments comes in. So fundamentally, all practitioners are trying to solve for two problems. In a cross-border kind of a scenario, ensuring that the end customer receives money instantly is no longer the challenge. From a rupee drawing arrangement perspective, this was done some 10 years back. But the real challenge or the silver bullet which everybody is pursuing is how do I pass real-time value? There is no panacea to that. Pre-funding is the order of the day. You have pre-funding, you have the technology to do it real-time. So that, I think, is number one. And during that, you do realize that can programmable money in a kosher manner have a role to play in this. There are various banks, including HSBC, which is dabbling overseas with tokenized deposits, which is also essentially a proprietary CUG kind of a network, which helps treasuries having multiple geographies move money real time. But there again, because it's a HSBC network, the pre-funding piece is taken care of to a certain extent, not fully. But the real problem is, in a multi-bank, multi-geography kind of environment, how do I solve for that? Technology is not the limiting point. You have everything which is required to do that. The end customer will be happy. But how does the ecosystem get to unlock that liquidity, as you rightly said? That's, I think.
So superb product view. And of course, I'm sure a lot of work is going on. Aman, you've been there on, almost, Bhishma Pitama, I can say. You've been in with MNC banks. You've done product building, sales, and of course now building a very formidable franchisee, IDFC. We see a lot of clients, heaping the praises. So when this all shift is happening or was happening, the settlement cycles were compressing. And of course, I was involved in a way for some time with you guys. Two aspects I would like to quickly cover. One is, of course, compressing these cycles, how much or how did the risk management spearheaded by your team manage? And second thing, again, as part of the ecosystem, how did the digital alliances were helpful in that journey?
Oh, certainly, and first of all, thank you very much for having me here, Vaibhav. I think, well, you didn't ask this question, but let me start with that point which you started the conversation, that corporate banking is complex. I think that's the first myth, so-called myth, is what we really want to, get rid of. Because banking, honestly, is, if you want to make it very, very simple, it is about giving money and taking money. I mean, that's it. That's all banking is. And the moment a transaction banking comes into picture, whether we talk about the global liquidity or the local part of it, you can keep creating various kind of layers associated with it. But I think from a customer standpoint, it has to be simple, simple, simple. And that's the only way you can grab attention of customers to understand that what really, as a transaction banker, we are providing on the table. But coming to your specific question, certainly there is a lot of risk management which is required, purely because from a liquidity point of view, when everything is becoming real-time settlements, and now, in fact, checks are also becoming continuous clearing coming into picture, I thought at least that will be T+1. That is also no longer T+1. In that scenario, you can certainly predict what, with a reasonable degree of confidence, that what is the outflow which you can expect. But certainly you cannot predict with that much certainty on the inflow which is expected to come. So moment that mismatch comes into picture, while there is an RBI, ASISO, which is your automated sweep in, sweep out models which are available, but certainly all of these pieces will ensure that the liquidity is available, but it comes with a lot of negative carry on the treasurers, right? So the risk mitigant part of it, it really comes down into fact on 2 or 3 aspects. One aspect is certainly that how well, as transaction bankers and liquidity managers, do we really understand that what is the kind of business which we are sourcing? Is that sector in which we are sourcing the customers, are those customers, what type of inflows and outflows those are supposed to have it? 2 is, what is the kind of payment railroads which these customers are using it? 3 is that what kind of limits which we have really given it to them, especially the post-treasury cutoffs which are there. Because the irony is that while the settlement systems have moved from 24/7, but not the markets, right? So, and that is where the problem comes into picture. It's ultimately a data analytics with which how much you can predict, whether you are 70% accurate or 80% accurate. That is going to really define that how much is the negative carry you are going to carry, right? So. It has a mix of, while I don't like this word AI because it is not used but abused word these days, but certainly it can play a very, very big role in predicting that what you're really going to do. I think to that extent you can manage the risk. And I think the second part of the question which you asked is related to partnerships, right? Now, so honestly, it could be a slightly different view from the general mass which is there, but our view from IDFC standpoint is that we genuinely want to work with partners on broadly two aspects. One, they should genuinely be able to add value. We really don't want technology service providers. We own the technology, and that's how we are working with it. So genuinely somebody who is able to add the value to our ecosystem, to our customers. And I think the second is the longevity with which we can work with, right? Because the shorter the approach with which we can work with partners, it is going to have a big negative impact on the customers per se. So I think from a partner ecosystem point of view, certainly it helps because not necessarily that I can build it on my own. But certainly if partners are able to come and give us that visibility, and especially if you ask from a corporate point of view, while they can connect with IDFC or probably HSBC or Citi, but still there will be 4 other banks who are probably connected or not connected in that form and shape. And probably that's where your role comes into picture, that can you provide a central view to that corporate across all the banks, right? And that's where probably the partnership really works.
No, of course. And I think I was just telling Mahima that this all started when I was consulting under you, and Vivek was the guy who was basically helping us to architect the platform. So, but I think moving on to the very interesting paradigm that why this is relevant for treasurers and the overall industry is also the important part of working capital, right? While not all the corporates are debt, they don't want debt, but some of them of course want debt. But essentially this also is a foundational layer for working capital, right? And that's where these globally, most of the banks and most of the corporates are very much tuned to this particular concept. And of course they spend a lot of time, money, effort. Initially it was AS400 mainframes, and then so many other technologies, AI now come into the picture. So I think moving to that particular aspect, Mahima, I think the industry over here, maybe they've heard these terms of notional pooling or netting and all, right? We can quickly cover from a global corporate's perspective that how does it work and whether it is relevant for India as a market or whether the global landscape what Indians are trying to play, especially after UPI, whether it's relevant for us as an industry to focus on that.
Yeah, sure. So I think you talk about working capital, right? And how corporates are looking to sort of unlock that in multiple ways. Financing it is one way, trade funding is another way. But the way we look at it is that, most often than not, you would see that it is not that liquidity is absent in the organization, right? It is just fragmented across entities, across geographies, and corporates therefore need to find a way to move that around pretty seamlessly, almost across the clock, right? So some of the things in our experience that have really been very helpful, especially for large corporates who have multi-geography presence, is to look at concepts like notional pooling, right? Or even physical pooling, which some of our corporates already do in India. But notional pooling is something that we haven't seen happening in India, linked to regulations, etc. But globally, there are multiple corporates and a lot of Indian corporates who are actually set up across the globe, particularly, you look at the tech segment, you look at the pharma segment, and they are increasingly delving into the space of notional pooling. Because what it does is that it gives them an ability to basically bring on a very complex structure of entities that may be existing in multiple parts of the world, where treasuries today are sitting decentralized. So in the hope of centralizing that treasury, having full visibility of the cash that is sitting across the globe for them, across these multiple entities through these complex structures, structures like notional pooling do really help. Because what it does is that it gives them a means to basically, square off the surplus and the deficit positions across entities, reduce the borrowing costs that they would have incurred otherwise, and obviously create much more dynamics in how the liquidity is getting deployed at multiple points in time, right? So that's just one part of how they are managing the working capital, and this is more sitting under the balance sheet optimization piece, right? The other piece is also that liquidity could be sitting in various parts of your supply chain today. And you've not figured that out, right? So supply chain, where there is liquidity which is sitting idle for you, especially in the real-time world, because you will have inflows, but you don't know how to really put them to use. That's where things like, say, dynamic discounting come into the picture, right? Where globally, corporates are increasingly looking to deploy that in their organizations to not only generate greater returns, yields from their balances, but also look at how to strengthen their supply chain, right? Make it more resilient. And third, but not the least, I think the other piece is also how can you instill liquidity within your payables, right? So things like commercial cards, for instance, is another piece which is really being looked at beyond just travel expense management space and moving into B2B supply chain in a very, very big way. So I think corporates, Vaibhav, are not just limiting themselves to one single solution. They are actually expanding themselves into multiple territories of working capital and seeing what really fits the bill for them.
So very interesting perspective. And I think Vivek, a few years ago I spoke about usage of API, and there was a factory in that case in point where the factory's door was getting open basis the API which was coming from the bank, right? And then there is an aspect of supply chain finance where your entire visibility has become so crucial that your commerce of course was powered by transaction banking, but now it's visible at the front, right? So I think from both this perspective, and when you see so many different aspects of product coming into the picture, be it commercial card, be it the, let's say, latest, updates from SWIFT or maybe RBI, how do you balance it out in terms of innovation? Of course, we will look at the compliance and profitability first, but how do we balance it out in terms of which problem to pick and choose? It's a very tough, hat. As a sales guys, all of us are going to come to you and say, Vivek, we want you to build this. How do you balance it out?
No. If anybody has an answer for that, I would really want to meet you all at the end of the day. But then a couple of guiding principles, right? And we have had chances to speak about this in the past as well. The way we have architected our systems need to have a fundamental change, and I think that has been recognized and everybody is realizing it. The core banking system is increasingly being debundled. You can't have the core banking system do all that you expect it to do and then also manage scale, real-time, resilience, and so on and so forth. So I think the payment hub concept is a reality. It's no longer a concept. Many banks have already implemented it. You hollow out the core and use it only as a store of record or as the thing. So in the vein of desegregating and then making specialized systems do specialized things, I think that one mentality from generalist to specialist is taking force, and that is something that product managers have to prevail upon and have a larger say in the future state architecture of how these systems are architected. The second guiding principle would be, while it is a much abused term, and for a long time every bank was trying to figure out what do I do with blockchain, right? But with a successful use case around tokenized deposits and movement of funds, and RBI also opening up to try and see if, certificates of deposits can be tokenized and so on and so forth. Forget tokenization, forget the crypto part of it. But the blockchain technology, I think, is a very, very good use case for a core banking construct itself, because that allows you the ability to configure on the go through smart contracts and other things within assets. Obviously, it might be an underkill for the huge potential that it has, but if it has to match the speed of the way the industry is reacting, I think the use of blockchain technology increasingly into creating solutions, especially product processors, will be very, very relevant. And I remember speaking to you about this as well. The product managers therefore need to be more and more equipped to use these tools which are created as a playbook. So the ability to quickly configure a pilot, try and see if this works, dismantle it very, very quickly and do it. If you notice now, doing any of this is a 3 to 6 month cycle each, that is when competing priorities and all of these things come into play. Not saying that with all of this in play, competing demands will not be there. That's not going to happen. I mean, we are a very needy lot all across, right?
And that's why I think ecosystem will also grow.
Yeah.
Because the more, as every bank or every country or every state, the more competing environment is there, the more innovations will prosper. I mean, that's there.
I think sorry, one more thing which I wanted to say is the network effect. Everybody has seen the benefit. So for example, if one bank, and we have tried it in the past in Yes Bank and every other place also, if one bank tries to create a blockchain network and expect the whole ecosystem to play in it, it is not going to happen. Cynicism is the last point. It's just too much of concentration risk. But at the same time, if it was an RBI or an IFSCA or a IBA which were to set this up, that would come up, right? So which is why the IBBIC and organizations like that are the need of the hour, because stated problems, known problems, acknowledged problems, and there is trust and faith and money in the system to invest in such things, which is neutral ground and allows for all of us to participate. I think Aman you were briefly mentioning about it, just brings economies of scale. All of us can focus on the real problems, right?
Super. Very interesting thought, and we are so excited to build something like that and with all support. Aman, I think a lot of use cases I've seen in last 5 to 6 years or 10 years we've been interacting, where IDFC and you as an individual, you've been involved in a lot of these use cases of embedded, be it cred or be it Mobiquick, be it so many other use cases where you have the invisible force powering that, efficiency, bringing efficiency to working capital management, right? And of course, you set up a completely new bank at that point of time as a product organization, as a business organization. So how did that entire transformation happen, and why is that most of the fintechs then want to build on top of this with you guys?
Well, I think, I don't know whether it's a fortunate or unfortunate, but certainly I am being part of IDFC since its inception. So I am party to whatever has happened in terms of building nuts and bolts around it. But I'll tell you, fundamentally, I think we did 2 or 3 things at that point in time, and which is what is paying off, as we believe. One point was that is there a need for, as I mentioned in the previous conversation, owning a technology? Answer is yes, right? And hence the dependency on the technology service providers need to reduce. So that is one fundamental change which we did, because what really happens is that if you really own the technology, you will be in a position to give genuinely the right experience to the customers, right? So that's point number 1. I think point number 2, which is where very fundamental, but there is a IT vertical, there is an ops vertical, there is a product vertical, so on and so forth, right? I think one change which we did in our world when we created IDFC, and it is going on right now as well, is that the UI UX designers, for example, or the developers are part of business teams, right? That creates a very different way of looking at it, that what really we want to do for the customers, right? Certainly there is a core IT team which is there who needs to look at whether the code which has been written is right or not. That's something as a business which we can't validate it. But that team who is developing it is part of business. That becomes a very, very big, very fundamental, but a big change according to us, which impact has come into picture. I think the third aspect is also this, that can we look at, and I think Vivek was talking about briefly earlier about this, was that can we really look at the ecosystem around this? Because more and more, if you keep creating silos within the organization, more and more distance you are creating with the customers. Ultimately, if I just take a very simple example, customer has raised an invoice, right? From an invoice, there is a PO which is there behind it. From invoice, he's sending it to his counterparty. Counterparty is supposed to make multiple payments to him. There could be a financing angle associated with it. There are multiple payment modes which are available through which the customer can make a payment. There is a reconciliation logic which need to come into picture. There is an API which need to be there, who need to go back to the customer's ERP system to update it, right? A single transaction can have, from a banking point of view, somebody as a relationship person coming into picture, somebody as a cash management person coming into picture, somebody, let's say if an underlying LC has been issued, there's a trade person coming into picture, there's a supply chain financing person coming into picture, right? That is the fundamental change, that can we look at this horizontally rather than looking at it more vertically. Vertically certainly is very important because you need to deep dive into what the customer needs, but horizontal effect is where it brings a lot of change. And I think that's how we try and see that when you talk about embedded financing or embedded partnerships, which we spoke about earlier, is all about that. Can we horizontally take care of customer requirements from his transaction journey perspective? I think those are the basic fundamental things which we did.
Very, very interesting perspective, Aman. I think we all touched upon the aspect of the platforms or the entities like Swift or NPCI. In fact, NPCI has been one of the greatest example of model what globally people are trying to follow, right? Because it's no longer a single organization powering payments, but it's also the center of entire innovation, right? And when we talk about complex product for the market, not for bankers like you or us, when we talk about a product like cash management or liquidity, these platforms have been there for a while. It's not that the Swift or Visa or MasterCard or most of these guys anchoring these networks we spoke about were there for a while. And the way I look at it from ex-banker and currently founder perspective is the AI or the blockchain, right? We spoke about blockchain. I think it's gonna get disrupted, right? Of course, there's a balance have to be there, right? So maybe Mahima, from your perspective, how the organizations, larger organizations or innovations team of City looks at these aspects, right? Whether you standardize the process or you innovate, with the agile method. It's a very interesting question. Typically, at least we get asked, right? Why these banks eventually would talk to this platform while let's say NPCI or IBDIC or Swift, and there are so many of them which are there in the market. So how does that internally works out, or how does it play in your mind from a business standpoint?
So the way I think about it is that standardization and innovation / customization that you would do for your clients are not really sitting on the opposite ends. The way to look at it is that they are probably part of the same stack, but possibly at different levels, right? So as a bank, when I would look at my systems, right, the core foundation has to be obviously standardized, as Vivek was also pointing out, right? So my core rails, my risk management framework, my compliances, etc., all have to be standardized, right? But it doesn't mean that I cannot customize or innovate around those standard rails that I have created. In fact, I think, like you said, we have an example of it really right here in India, right? The digital stack that was created has given the leverage to so many fintechs to innovate, not just on UPI, but also so many other things that are happening in the market. It's all because of, that you have created the framework, you have created the guardrails, and you let people innovate within those. And that's the model that we follow as well. So, Aman was talking about partnerships earlier. So we also firmly believe that, when we have created that foundation, we can definitely bring in partners who would, be a lot more agile than a bank like us would be. And we look at, these specific problem statements with a different eye, and create solutions which are actually targeted to the problem statements of our clients, right, particularly. But they can do that on the edge as we build the foundation right for our clients, because at the end of the day, clients are looking for that confidence that whatever be the innovation, my money is secure, my funds are secure, right? So I would say that's how we balance it out. We do create standardization, but we definitely leave a lot of room for customization and innovation. And the way we look at it is that it is not really a constraint, but it is probably the right sort of foundation for keeping your innovation sustained, right? Yeah.
No, perfect. So we have got 3 minutes, Vivek, and then Aman, I'll look for that. So I think, and HSBC is to be known as world's local bank. I think there's a very famous thing what we all learned, and I was always fortunate to be the banking service provider as a bank or as a fintech for HSBC. So in your standpoint, and you mentioned about IBDIC and then of course NPCI, what part of the business or product roadmap is driven by these entities? For example, just a quick example could be, let's say IBDIC comes up with a particular framework, right? Whether that exactly drives the organization. ICC came up with the APIs, trade APIs, right? And it was a very interesting product. But there are, I think, far too many priorities, as we discussed earlier in the panel, from a liquidity and cash management standpoint. So how does that play into your mind?
Okay, then three things only. What I started off with, the mindset has to be you build something with the customer in mind. That could be, and it is established that it is diametrically opposite to what your end objectives are. So the enterprise hat, and you look at the customer. Second, you also build keeping in mind the landscape. RBI releases a 5-year vision document, and very seldom do they steer away from that. And it is also manifested in the product roadmap for entities like NBCI. If you look at the sheer number of companies they have spawned and the work that they are doing so that they can focus on it, that is a clear indication, right? I mean, so it's not as if their changes are instantaneous or overnight. So there is a 5-year vision document in place. Including things like how they expect cloud to shape up, how do they expect digital currencies to shape up, and so on and so forth. So there is enough guidance in the market on which way the regulator is headed, which way the payment operating systems are headed. This plus the combination of what the customer ultimately needs in your own context. Because the context in which I look at a corporate as a multinational bank may be significantly different from how some other bank may be looking at it. So it cannot be that what one bank does suits the other. So a combination of these things is the general good principles to follow.
Super. Aman, quickly, I think we've seen cities and JP Morgans and HSBCs of the world dominating this. In your earlier stint, you were part of that league, and now, of course, you are the shining India story example. How does all these innovations, what you've been building for since the founding team of the INS, how does it help you to take a leadership position or a pole position? And Modi ji would love that when an Indian bank goes over there. Not that they are my dear friends, but how do you see that coming into the leadership, product leadership, segment leadership? How do you look at that? You, of course, getting into entire, let's say, global corporate and getting into leadership will be, of course, there has to be a dream, but what is it that you plan internally?
So I think 3 or 4 things, again, are very important from a leadership standpoint, and it's not, my own individual aspect, but I think at IDFC what we really follow is that, I think one point which I said earlier was related to vertical versus horizontal. So I think that is the key, in my view, where the change from a leadership standpoint need to come into picture. I think the second point, and which I certainly follow, is that there is a lot of unlearning which we need to do. And while you're calling me like a Bhishma Pitama, but I'm certainly not that. But there is a lot of unlearning which we need to do, because if we don't unlearn, there is not new things which we can learn, right? And I think gone are the days where the leaders can be aggregators. I mean, you have to genuinely be on the ground, understand what the new stuffs which are coming in, whether it is AI, whether it's blockchain, whether it is real-time liquidity management, what all new things which are coming up. You need to be on the toes, you need to keep learning day in and day out, and I think that's where, from a leadership position, which somebody need to lead genuinely by example, it's a big change which need to happen. I think third piece is a focus, which I certainly believe in, and which is where I think that things should move forward, is really the following the money in terms of programmable version of it, right? Because while in CBDC we are talking about this, but if I really want to know that the money which I have given it to somebody, to what purpose he is supposed to utilize it, not only in CBDC but otherwise as well. I think that is a concept which need to evolve over a period of time, because that will give a lot more control not only to the bankers but also to the institutions who are utilizing that money. That is that money which is going out or coming in, is the purpose really known, and is it programmable version of it? And I think the last aspect is, and the point which I started with, that corporate banking is not complex, is because I think the theme which we are really working, and more from a leadership standpoint also, is that you have to make transaction banking invisible to corporate customers. It has to be a Uber experience where you just get in, point A to point B, get out. You're not worried about your transaction money into the background. In a very simple terms, if you're able to create that kind of an environment for the corporate customer where transaction banking becomes invisible, I think we will achieve something in our life.
Great conclusion, great thought. I think time's up. Maybe can we take one question, possible? Anybody? Any questions? Yeah?
Yeah, hi. We discussed various points, liquidity, fragmentation, and notional and making the transaction invisible, but are you going to face the cultural or regulatory hurdle, main the cultural hurdle in some of the corporates still in adopting the invisible transaction banking?
Maybe I can start and you guys can pitch in, but I think, see, it has to, and as I said, banking is either giving money or taking money, right? It is up to transaction bankers at what kind of layers which we are creating it. If we are able to create a layer, we are able to demonstrate that layer, whether it is to the regulator or whether it is to the corporate, right? I think that's where the demonstration of the invisibility which is required, or the or let me put the other way around. For example, in IDFC we have created something called as a business transaction monitoring, which today really gives a visibility to our customer for every transaction, whatever they are processing it. They have a 24/7 dashboard available with them to know what is the status of the transaction. That gives a lot of control and visibility to our customers that yes, this is something which is doable, right? So I think it's a more of a concept which need to be proven, accepted by the corporates, and I'm sure the kind of regulator with which we are working in India, everything and anything is possible, and they will be more than happy to look at these kinds of proof of concept if there are, the guardrails are up there to that extent. So I think that's what Raji also.
Yeah, thanks.
I saw a lot of hands were raised, but maybe I think time's up. I think 5 minutes. Maybe we can have offline discussions once we move out. So thanks once again. It was a great, insightful panel discussion, at least for me. I don't know others. So thanks everyone. Thanks Digital 50 again once again.
Thank you so much, ladies and gentlemen.